G'day, welcome to English Absorbed, the English learning channel for you to learn English the right way with me. My name's Jesse, let's go. Today on English Absorbed, we are going to be talking about vocabulary that you can use when you are talking about trading, the markets, etc. Whether you're trading stocks, cryptocurrencies, commodities, whatever kind of asset that you're trading. This is pitched at language learners, but if you are an English speaker, hang on because this might be useful to you too. I'm going to explain a lot of the vocabulary that you're going to need. The only difference is I'm going to be doing it very clearly. During this video, I am going to use footage from the YouTube channel Crypto Banter, which is a pretty good YouTube channel for cryptocurrency. Check them out. I'm going to link them in the description. But they will use a real example of the vocabulary that I'm talking about in context so that you can see it in context, because it's always important when learning vocabulary to keep it in context. Let's go. The first term that we are going to be looking at is correction. Now, a correction in the market is any drop in the market of about 5% or 10%. It's not exactly a crash, but it is when the price of your asset goes down a little bit, and it could last for days, months, or weeks, but it just means that the stock was a little bit overbought. It's going to go down 5 to 10%. Nothing really to worry about. It's just a correction, making sure that the market is pretty much at the correct price all the time. So a correction is a drop, temporary, usually of 5 to 10%.
So what is causing this correction?
The next word that we're going to look at is an adjective, down. If we say the markets are down, that means that the markets have dropped a little bit and that they're not at their all-time high. They're down. They've gone down. Conversely, you can also talk about markets being up, meaning that they've just raised a little bit. They've gone up. The markets are up.
The US stock market is now down 2.35%.
A dip. A dip is similar to a correction, pretty much the same thing. A drop of 5 or 10%. So maybe your commodity was at $95 and it's going to drop to $90. It's going to dip. That is the dip. A lot of people say, buy the dip. I'm sure that you've heard this before, meaning it's better to buy low than to buy high.
That is what's caused this whole dip.
A pullback. Lots of words that mean pretty much the same thing. A pullback is the same as a dip. It's the same as a correction. It's a pause or a moderate drop in a stock or any commodity from recent peaks that occur within a continuing period. So a little pullback on its way back up.
Remember, the markets can't just pull back like this.
A trend line. Now, when you're looking at any chart of any asset, you can draw lines that you believe are trends. So a trend line is an easily recognizable line that traders can draw on charts to connect prices together. You might see the lowest point and the highest point and draw a line between those two, and that is your trend line. So you can kind of try to predict where that stock or where that asset is going to go in the future. A trend line.
I bet you that the wick just touched the trend line.
Basically shuts up exactly to the trend line. So there we go.
Bang on the trend line.
Beautifully
Yes.
on the trend line.
A rally. A rally is a period of sustained increase in a particular asset. It could be a rally of a couple of days, it could be weeks, it could be any time period, but a rally is where your stock or your asset is going up, 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 up. Rallies are pretty good if you're longing your asset.
And every single time has been the lows of Bitcoin to a massive rally that came then after that.
A bull market. A bull market. A bull market is a period of time where your asset will increase as well. If you have a rally, then you could say, we're in a bull market. Bulls like the price of the asset to go up. Bears like the price of the asset to go down. A bull market is a period in which your asset is going up.
We got bulls and bears in the market, right?
Bullish and bearish. These words are pretty much just adjectives of bears and bulls. If the market is bullish, it's going up. If it's bearish, it's going down.
We got bulls and bears in the market, right?
Too long and too short. These are verbs If you long an asset, then this is what most people do. You put money on it and you hope that it goes up.
Bitcoin, longing Bitcoin, longing Bitcoin.
If you're shorting the asset, then that's a trading technique in which an investor sells the security with plans to buy it back later. And it's a strategy when an investor anticipates an asset going down, at least in the short term.
Just adding, and I just see the shorts just going up.
The general verbs when we're talking about the market is, I think the market will go up or it will go down. This is because up and down are not actually verbs. They are prepositions. So you cannot say, I want the market up. I want to up the market. No, I want the market to go up. I want the market to go down.
It might go down, but it needs to go back up.
Resistance and support. Now, when we're looking at a chart, we can see lines of resistance, which is basically the stock's going up. And for whatever reason, we think that when it hits this point, it's going to have trouble getting through that particular point on the chart. So it hits resistance and then it probably goes down. Sometimes you can break through resistance. So the stock goes up and we think, oh, what's it going to do? And it just breaks through that resistance line. A resistance line. A support line is kind of the opposite of a resistance line. When we see the price going down, we can try to predict where it's going to bounce back up. So the support line is when your stock or your asset is going down, and for whatever reason, we draw a line on our chart and we say, I think this is the point of support, and the stock is either going to stop going down here or bounce back up and go in the opposite direction. Support.
Adding in these areas at all. Is any break of resistance test as support?
A pump. A pump. Now, some people say that the market is pumping when it's going up. But generally in cryptocurrency, we refer to a pump when the market is being manipulated up by people who have a lot of this cryptocurrency. We usually call them whales, and they will throw all of their money into this cryptocurrency or coordinate a few people to do so, and they'll pump that cryptocurrency up so that they can then capitalize on the fact that they know what's going to happen with that particular currency. Now, in stocks, this is pretty illegal, but cryptocurrency, well, this happens all the time. A dump is the opposite. A dump is when people have huge amounts of money in a particular currency or cryptocurrency, and they'll sell it all at the one time. And then on the chart, we see it all goes down at the one time. And they do this as well to manipulate the market, pumping and dumping.
Getting out on a pump and not getting out on a dump.
Sideways. If your market is going sideways, then it's pretty boring. It's neither going up nor going down. It's just sort of traveling sideways for a while. Stocks, assets, cryptocurrencies, they can do this for weeks, months, and it can be pretty boring. Sideways.
Dominance is sideways at the moment.
A bounce. Now, your stock could bounce off its level of support. That means that it's gone down. It hits the support, and just like a ball, it bounces back up. A bounce.
Well, when we have a bounce in the market and an altcoin bounce, we're going to have a really strong bounce off of this area over here.
To ladder in. Now, this is one that I don't hear too often. I do hear it from our friend Sheldon the Sniper, who we've been hearing from in these little clips. And he says a good idea is to ladder in. What he means is to put your money in slowly, day by day, or when you see an important move in the market. Don't just ape in. Aping in is where you've got $1,000 and you go, oh, I like that. I'm going to put $1,000 at the one time into that asset. We've all been guilty of that. And then it goes down and you lose a lot of money. If you just ladder in, then you get more of a dollar cost averaging effect, which means that you put $100 in one day, a few days later you put another $100 in, maybe a week later you put another $100 in, and then you get an average price for the period in which you were putting that $100 into the market. Dollar cost averaging, or as Sheldon says, laddering in.
Now you want to start laddering in your buys. You don't want to be laddering. It could go a bit further down.
Bags. Now, when you have a position in an asset, you have a big bag full of that asset. And generally, if the asset goes down and you don't sell and it keeps going down and it goes down to zero, then you are left holding the bag, a bag without any money in it. You don't want to be left holding the bag.
So I'm going to be loading up 50% of my bags in these zones over here.
Whales. We talked about this one a little bit before. These are individuals or groups who have huge amounts of money in a particular asset, usually cryptocurrency. So a whale is somebody who has hundreds of millions, maybe even more, in a particular asset, and then they can sell everything at one time or buy everything at one time in order to manipulate the price of the cryptocurrency so that they can capitalize, meaning make money, from that move. Because what do whales do? They swim around eating all the little fish, right? When whales manipulate the market, you might be a little fish and they want to eat you. Panic. If you panic in real life, you completely lose control and you might do something irrational. When you are investing, it is best to remain calm. Do not panic. If you panic sell, then you see your asset going down 5% or 10% and you sell it. And then you lose 5% or 10%, and the next week it goes up 20% and you've lost money. Don't panic.
This is the beginning of the panic. The beginning of the panic. Panicking. This is not the end of the panic. So
don't panic, remain calm. Be a calm investor. That means that if you see your asset moving down 5%, you need to remain calm. Remind yourself why you invested in that asset in the first place and be patient and wait. A good investor is patient and calm.
Everyone here is so calm. It's like, we're so calm.
A spike. Oh, last one. It's getting late now. You can see the light. A spike is a sudden and dramatic move in an asset. Usually we talk about a spike to the downside in my experience, but some people talk about spikes to the upside, meaning that the asset goes down very quickly or the asset goes up very quickly. A spike.
We had a spike from dominance.
All right, guys, thank you very much. I hope that you've enjoyed this little vocabulary lesson in trading, stocks, cryptocurrency, etc. This kind of vocabulary is not only useful in cryptocurrency or stocks, it's also very useful in reading any kind of chart or talking about any kind of chart. Therefore, I do recommend this kind of vocabulary for use in a test like the IELTS test, where sometimes you need to interpret the charts. So definitely do remember all of this vocabulary, try to write it down, try to study it. Thank you for watching English Absorbed, and I will see you in the next one.